Have you ever watched a company reach a moment so critical that everything, its future, its survival, its entire identity, depends on what it does next? That's exactly where Rivian stands right now. And the big question hanging in the air is whether the newly announced R2 can actually pull this company back from the edge. The excitement around the R2 launch was loud, fast, and impossible to ignore. But excitement doesn't equal success. The deeper you dig, the more you realize that this SUV might be Rivian's last shot at staying in the game. The company's CEO recently unveiled the R2 at their Irvine headquarters, and the media treated it like a major turning point. And it could be, if Rivian can execute perfectly. The vehicle is projected to arrive in the first half of 2026 with a starting price around $45,000, plus a promised range north of 300 miles, room for 5 people, and a performance model that can reportedly hit 0 to 60 in under 3 seconds. But don't get fooled by that speed claim. Those top-tier specs won't be anywhere near that base price. Still, Rivian clearly hopes this model will appeal to the mass market. And at first glance, the R2 looks basically like a slightly smaller, slightly slimmer version of the R1S. There is a reason for that. Rivian designed the R2 and R1S around the same time with the same design philosophy. It isn't just a copy, it's the other half of a plan that was years in the making. Rivian originally intended to build the R2 at a new $5 billion factory in Georgia. But building a massive plant from scratch proved too slow and too expensive. So instead, they pivoted and now plan to expand their existing factory in Illinois, which will still cost billions and will still require tremendous scaling. This shift alone shows the pressure Rivian is under. When a company starts cutting years off plans, it's because the runway is shorter than anyone wants to admit. This launch is Rivian's equivalent of Tesla's Model 3 moment, the make-or-break shift from a luxury-only brand to a brand that can appeal to the mainstream. But pulling this off is far harder than it looks. Rivian hopes to offer a $45,000 starting price, but achieving that price while making a profit is another story. If it were simple, every struggling EV startup, Fisker, Lucid, even legacy automakers would have already done it. Instead, Rivian enters this moment with only about 6 quarters of cash left, and they just lost roughly $5 billion in the last year alone. They're not just unprofitable, they're losing around $43,000 on every vehicle they sell. Imagine trying to scale production while hemorrhaging cash with each unit. It's a brutal equation. Sell more, lose more. To make matters worse, Rivian remains deeply dependent on outside suppliers for core components. While Tesla spent years bringing seat manufacturing, motors and electronics and more entirely in-house, Rivian still relies on companies like Samsung SDI for batteries, ZF for motor parts, and Magna for key systems. Tesla's vertical integration is why they can cut costs aggressively. Rivian's reliance on suppliers makes cost-cutting far harder. And the R2 was designed before the R1S, meaning Rivian hasn't even incorporated the best, newest cost-saving architectural improvements that Tesla now uses, like 48-volt systems. To survive, Rivian must hit a series of nearly impossible targets, and each one is high risk. The first is demand. The R2 has to launch with huge, undeniable demand, not tens of thousands, hundreds of thousands, if not close to 1 million. Rivian lowered the pre-order deposit from $1,000 to just $100 because they desperately need big numbers. They got around 68,000 orders in the first 24 hours, which is great, but the initial surge always represents the superfans. After that, demand typically slows. And unlike the R1T and R1S, which were unique and built early brand excitement, the R2 will be staring directly at its biggest obstacle, the Tesla Model Y, the best-selling vehicle in the world. Rivian isn't entering an open lane. They're entering the most competitive part of the market with the most dominant competitor in the industry. The second thing Rivian must do is deliver the R2 on time. And on time means the first half of 2026. But even that may already be too late. Every delay shortens their financial runway. They cannot afford a late launch. By 2026, they'll be down to fumes unless something changes drastically. The third requirement is pricing. Rivian cannot raise the base price when the vehicle arrives. They need that $45,000 starting point to stay intact to compete with the Model Y, which is already priced around $43,000 before incentives. And Tesla is known for lowering prices further as costs fall. If Tesla drops the price again, and they likely will, the R2 faces an even steeper challenge before it even rolls off the line. Fourth, Rivian needs the R2 to qualify for the full federal tax credit. That means battery minerals must come from North America or a qualifying free trade partner. That's a tall order for a company that still relies on overseas suppliers for major components. Without the tax credit, the R2 instantly becomes less competitive. Fifth, the R2 must be genuinely profitable. Not break even, not low margin, actual profit. Ideally around 10%, which is a staggering ask from a company currently losing tens of thousands of dollars per vehicle. They're not close, nowhere near it, and 2 years is not much time to turn around a manufacturing and supply chain model that has struggled since day one. Sixth, Rivian claims the R2 will offer a very high level of autonomy with 11 cameras and 5 radars. But autonomy is a field where real-world data matters more than hardware. Tesla has billions of miles of real-world driving data and is updating their system constantly. Rivian is years behind. If Tesla achieves true hands-off full self-driving before the R2 launches, the entire competitive landscape shifts. Why buy a vehicle that can't offer the same capabilities? Rivian also teased an R3, a smaller, even more affordable model that could appeal to an even larger audience. But none of that matters unless the R2 succeeds. The R3 is like planning dessert while the main course is burning in the kitchen. And even if Rivian nails all 6 of these challenges, there's a step 0. They have to stay alive long enough to deliver the R2 at all. Their margins were improving for a while, then reversed direction. In one quarter, they were losing around $33,000 per vehicle, but then the next quarter they slipped backward again. This suggests cost-cutting tricks, temporary measures, or one-time optimizations, but not sustainable progress. Even if Rivian solves production, cost, and supply chain challenges, there's another overlooked issue: service. You don't buy a vehicle unless you know it can be serviced. Rivian's service network is tiny. They barely have enough coverage to support the current fleet of R1 vehicles. Scaling service is massively expensive, and they'll have to do it right when their cash burn is at its peak. Tesla struggled with service too, but they spread that investment over years of selling higher-margin luxury cars. Rivian doesn't have that luxury. The only box Rivian has already checked is charging compatibility. The R2 will use NACS, meaning Rivian customers can access the Tesla charging network. That's a huge relief for buyers, but it doesn't solve Rivian's core business problems. As the pressure builds, it becomes clearer that Rivian might not have many options left. If the R2 doesn't bring massive, sustained success, Rivian might face a merger or an acquisition. There's even speculation that a company like Apple, after canceling its decade-long EV project, might be looking for a ready-made brand to buy rather than starting from scratch. Rivian has strong brand recognition, attractive designs, and a devoted customer base. But none of that fixes the cost problem. Without profitability, demand doesn't matter. Even the electric delivery vans they are producing for commercial clients don't guarantee survival unless those vehicles are profitable, and Rivian has never revealed whether they are. And then there's the ticking clock of competition. By 2026, the landscape shifts again. Tesla's next-generation lower-cost vehicle is expected to launch. Rivian might be preparing a $45,000 SUV for a market where Tesla sells a $25,000 vehicle. And that doesn't even include what companies like Kia have planned, models likely to launch sooner and at lower prices than the R2. Even if Rivian nails its launch price, the model offering 3-second acceleration won't be that version. That configuration will push the real selling price much higher. possibly well into the mid-50s, making the comparison to the Model Y even tougher. Rivian is loved by many for its design, its adventurous branding, and its vision. The R1T and R1S created a strong emotional connection with owners, and in many ways, Rivian proved it could innovate. But innovation alone doesn't save a company. Manufacturing efficiency does. Profit margin does. Strategic timing does. Right now, Rivian is entering the most difficult phase any car company can face, scaling to mass production without the financial cushion needed to absorb mistakes. Every misstep shortens their runway. Every delay increases risk. Every cost overrun pushes them closer to the edge. As things stand, the future of Rivian hinges on a vehicle that must